key focus for today is on the first US inflation print of the year that's out at 1:30. So we're going to have a look at what the trajectory is for the US inflation path. Does it mean the Fed is going to have to change anything? How might the market react? This is what we're going to take a look at today. And the trading takeout is going to be hype. What happens when something is hyped up, but then perhaps the news release of it means that an asset sells off? We're going to have a look at an example of that too in the Trading Takeout. Make sure you hit subscribe so you can see these videos every single day in your YouTube feed so that you can maintain your market edge. Rather than reinvent the wheel here, we're going to look at what News Squawk have been saying, because they always do a very, very thorough analysis, and they've already looked through all of the key quotes that have come about with regards to US inflation. It's out at 1:30 today, and the market is feeling a little bit tentative at the start of the year. I don't really know what it is. Sometimes I get feelings where I'm just like, what's going on? I can't really put my finger on it, but something feels strange, let's say. I'm not saying up or down or anything like that, just something feels weird. But let's go through the expectations. US headline CPI is expected to rise 0.2% month on month in December, with the previous being at 0.1%. And the annual measure is seen ticking up to 3.2% from 3.1% prior. The core rate of CPI, so that's inflation without energy and food, is seen rising 0.3% month on month, matching the rate seen in November, while the annual rate is seen to slip to 3.8% with the previous at 4%. Now, the drivers of this, inflation continuing to fall in November, but core inflation remains sticky at a higher level than what the Fed would like. It appeared less likely that the Fed will implement a rate cut in the upcoming March 2024 meeting. Meanwhile, last month, 0.3% month-on-month rise in core inflation was driven by a rebound in used vehicle prices. It notes that after sharp falls in previous months, gasoline prices were little changed, and the decline in that gas means energy prices may nevertheless have fallen further. So there is some potential then for, based on how energy prices have behaved over the last couple of months, there's some potential for that being the key driver of the headline inflation. And of course, headline inflation does feed into core inflation as well. If energy prices are falling, then the basket of consumer goods is likely to fall concurrently, because obviously producers need energy to make goods. They need energy to transport goods. Services require energy, I guess, as well. If you're taking human capital, so labor, people have to pay their energy bills. So if that's falling, they'll demand fewer wages, which means there's more dampening on the CPI basket. So I think that energy still is the key component here. And if we look at the producer price index as well, which has completely collapsed, it's collapsed nearly to 0% almost. It might even have dipped lower than that. We might actually be in deflation for the producer prices. If we look at that metric as well, it kind of shows where the trajectory is, because the producer prices are the ones that are first in the supply chain, if you like. Then it's, logistics and transport, and then it's the consumer that's hit. So the fact that producer prices have been hit and have been whacked massively kind of shows this broad-based feed through into how the basket might be behaving. Now, it does actually say here that, where did I see it? Yeah, it says that elevated wages in the services sector continue to add an element of stickiness. Now, going back to what I just said with regards to energy, if energy prices have collapsed and people require, less money basically to fund their energy bills, then of course that's going to mean that the overall basket of CPI goods is going to lower, because prices of goods don't need to be as high. And it's the same for businesses as well. So I think this is a very, very interesting way to start the year and to anchor the year, actually. If we get a softer print today, it means that March rate cut bet, will increase rapidly. So I would expect there to be a sort of support level put into equities. Now, I do think that the S&P 500 up here has some cautionary tales about it. I do think that if unemployment starts slipping, then that is a real troubling issue. But we're seeing it be completely sticky. Now, the one thing that could be distorting this data is the amount of people that have gone onto welfare. Now, I don't know if this is the amount, if it's a similar situation in the US or not, but in the UK, it seems to be that there is, I think from the chart that I remember seeing, 20,000 people per month added to disability benefits. That's a huge amount of people. It could even be per week. So this data would mean that if you're on disability benefits, you're basically out of the workforce, which means that you're not counted in unemployment statistics necessarily. You're not looking for a job, you're on long-term sick. So if that's occurring, then how bad is the unemployment situation in actuality? If there's working age adults that are now on long-term sickness benefits, post-COVID, it seems to have gone absolutely haywire. I'm not too sure why, and I would be very, very dubious that many of those claims are actually correct or true, quite frankly, because it's such a massive increase that it just simply doesn't make any sense whatsoever. So that's something that I would also have a think of too. You know, are the unemployment statistics completely dodgy? Because unemployment is composed of people who are willing and want to work, who are looking for a job, but don't currently have one. They don't include people who are on long-term sickness benefits or welfare. So bear that in mind, because that's a really, really key issue here with regards to what, you know, central banks might be looking at over the next couple of months. Now, with regards to the Fed policy, traders will be looking to see if there is any resurgence in price pressures that could knock the market's dovish view of the Fed's rate trajectory. I find that word so hard to say. Currently, the market is pricing almost 6 25 basis point cuts this year versus the FOMC's December projections, which have penciled in just 3. This week, the influential FOMC Vice President John Williams said that it was still too soon to call for rate cuts, as the Fed has some distance to go on getting back to the 2% inflation target. What's interesting there is how the market is overpricing rate cuts versus the Fed's projections. So the Fed is more hawkish than traders, okay? Which kind of sets up a weird dynamic here. It sets up a dynamic whereby traders who are actually influencing the buying and selling of the market are able now to cause more surprise if there are fewer rate cuts. That's quite troubling if you're holding risk, basically, because what that means is that if hikes start to get priced in, traders are going to have to reverse their positions massively. So that's what we're looking at. That's what I always mention as regards to what is current consensus versus the level of surprise, right? We're looking now at 6 25 basis points. What if inflation reduces that to 4 25 basis point cuts? That's hawkish from where we were. It's still dovish overall, but versus the baseline current expectation, that's hawkish. That's a big hawkish change. So focus on things like this when it comes to surprise, you know, levels of surprise and how they might influence asset prices. But yeah, I'm expecting to be pretty much bang in line. If softer, that would be very interesting. It could mean that, you know, the Fed's projections are overly hawkish, and, you know, things get wound pretty quickly. You know, people start buying risk again. But I think the whole aggregate picture is dependent on unemployment, and unemployment just isn't going anywhere just yet. So I don't think there's anything to worry about. Maybe if we start getting some negative, some worse prints on unemployment, that is when we have to start saying, okay, maybe it's time to concern ourselves with something. So the Trading Takeout today is based on the Bitcoin ETF. Now that it's a regulated product in the US, I think I can actually talk about it. And it's to do with buy the rumor, sell the fact, okay? So for the last year or so, I guess, we've had a massive hyping up of the Bitcoin ETF over in the US. Of course, Europe, Canada, other places have had crypto ETFs already. If you didn't know, you can actually buy a crypto ETF in the UK that is focused on Bitcoin. It's run via Han ETF, I believe, if I recall, and it might be called BTC I'll have to double check that, but you can actually invest in crypto in ISAs, in pensions, in via ETFs in the UK, Europe, and outside of the US. But the US one is naturally the big one, purely because the SEC basically rules the world in effect. So what we are focused on here is, does hype match up to reality? So people prefer the anticipation of an event rather than the actual event occurring, because that means then that you have to actually do stuff. It means that there is now an expectation. It's like when you are listening to let me rephrase that. There's a program called Silicon Valley, and one of the skits in it is when one of the guys is like, oh yeah, then we can make revenue. They're a tech company. And then the other founder is like, wait, why do you want to make revenue? And the guy's like, well, because then we can make money. And he's like, well, when you make revenue, that's when you have an expectation. You then have to make more revenue and more revenue. So this is kind of where buy the rumor sells the fact comes into things. And this could be a situation that occurs in this Bitcoin ETF announcement, is that because it's been hyped up so massively and people have already been buying on expectation of it going up, has it been exhausted? Is there now a barrier to overcome with regards to the bid? Is the bid purely based on expectation now? And this is something, that can occur quite a lot in markets. Pricing in is something that's, pretty well examined. You might get a good data point, but because people have already been expecting that good data point, the market actually sells off. You get things like this all the time. So with the Bitcoin ETF, I'd be wary with regards to whether crypto heads higher from here drastically. At the moment, it's still bobbling around 46.25K. So just bear that in mind, is that the hype is sometimes overdone when the actual news is released.